Hello students and welcome to Finance for Engineers course. Students, in earlier lecture we have seen important aspect concerned with cost of various sources of fund. So over there we have seen what is cost of debenture and how to compute that, what is the formula applied for calculating cost of debenture. After that we had discussion about the cost of preference share, and we come to know that two types are there concerned with preference share, that is redeemable and irredeemable preference shares. In earlier lecture, we have a discussion concerned with calculating the cost of redeemable preference shares. And now in this session, we are going to learn about the computation of cost of redeemable preference share capital, and also we will focus on the cost of equity capital. That means here we will try to understand what is cost of equity capital and how to compute it. What are the different methods used for computation of cost of equity? So this is an example. A company issues 1 lakh 10% preference shares of rupees 10 each, and you are required here to calculate the cost of preference capital if it is redeemable after 10 years. That means the period is 10 years given, and you can see here the redemption value of the shares is rupees 10 each, and 1 lakh shares issued by the company. That means the redemption value must be 10 lakh, and 10% is the rate of dividend. So this is the information given in an example. And now we have to calculate the cost of preference capital if they are redeemed at par after 10 years, and second is if they are redeemed at 5% premium. So let us see the solution for cost of preference capital if they are redeemable at par. So this is the formula which we have seen in earlier lecture. Now DP is the dividend, RV is redemption value, NP is net proceed, N is period. So like this, we'll put figures into this formula. So here you can see dividend 1 lakh plus RV is redemption value 10 lakh minus NP 10 lakh, N, that is period, is 10 years. So by this way, we are putting figures in the formula, and by solving this equation, we get cost of preference capital if they redeemed at par is 10%. So now we will see the second condition, that is if redeemable at a premium of 5%. So same formula we will be applying here. You can see here dividend will remain same 1 lakh. Now RV, that is redemption value, changes here by 5%. It has increased. As increase the premium, we have to add that 5%. So 10 lakh 50,000. Net proceed will remain same 10 lakh. Period is 10 years. So by solving this equation, we get the answer, that is the cost of preference share capital if they redeem that premium 5% is 10.24%. So by this way, we can calculate the cost of capital with one or the other condition. Now, next point of discussion is cost of equity capital. So cost of equity is the expected rate of return by the equity shareholders. Some people argue that As there is no legal binding for payment to the equity capital, no cost concerned with the equity capital. But see, it is not correct. Equity shareholders normally expect some dividend from the company when they make investment in a shares. Thus, the rate of return that is expected by these equity shareholder become the cost of equity. Conceptually, cost of equity share capital may be defined as the minimum rate of return that a firm must earn on the equity part of total investment in a project in order to leave unchanged the market price of such shares. And for the determination of this cost of capital, it may be divided into two categories. First is external equity or new issue of equity shares, and next is retained earnings. The cost of external equity can be computed by applying the following approaches. And here the first approach is dividend yield or dividend price approach. Next is dividend growth method, and next is earnings yield method. So these are the methods. Yet another methods are there, but here we are going to discuss these three methods for calculating or computing the cost of equity. Next is, let us start with the first approach. First is dividend yield or dividend price approach. So according to this approach, the cost of equity will be that rate of expected dividends which will maintain the present market price of equity share. And it is calculated by applying a following formula, that is KE. KE means cost of equity is equal to D upon NP. And this formula is used for calculating cost of equity for new equity shares, or we can use the formula KE is equal to T divided by MP. That is, this formula is useful for existing equity shares. So now what is this KE? K is cost of equity. D is expected dividend per share. NP is net proceed per share, and MP is market price per share. So this approach rightly recognizes the importance of dividend. However, it ignores the impact of retained earnings on the market price of equity shares. This method is suitable only when the company has stable earnings and stable dividend policy over a period of time. So let us see an example concerned with calculating cost of equity. See this problem. A company issues 10,000 equity shares of rupees 100 each at a premium of 10%. The company has been paying 20% dividend to equity shareholders for the past 5 years and expects to maintain the same in the future also. Compute cost of equity capital. Will it make any difference if the market price of equity share is rupees 150? So here we have to calculate cost of equity for new share issue, and if it has already issued and its market price is 150, then what will be the cost of equity capital? So two calculations we have to show. First for new shares and next is for existing shares. So you can see the information given here. We have to apply this information in a solution. So let us see the solution of this. First, we will write the formula for new equity shares, that is P upon NP. So it is already given dividend rupees 20 divided by NP, that is 110 into 100. And by solving this, we get the answer, that is cost of equity is 18.18%. Now by applying the formula for existing equity shares, it is already given that the market price is 150 per share. So we will put that figure. So you can see here dividend remains same, 20 rupees divided by 150, the market price given in an example, and here the answer is 13.33%. So for existing equity share, the cost of equity is less, that is 13.33%, while for new equity share, the cost of equity is 18.18%. So by this way, when one can calculate the cost of equity by using the dividend yield approach. Now the next is dividend growth method. So according to this method, the cost of equity is determined on the basis of the expected dividend rate plus the rate of growth in dividend. This method is used when dividends are expected to grow at a constant rate. That means here it is expected that the dividend is growing year by year after year, and therefore there is a need to identify, calculate the cost of equity. So for that purpose, this is the formula used for calculating cost of equity. So you can see here T1 divided by NP plus G, and this is for new equity shares, while in case of existing equity share, there is a change in a formula. Instead of NP, we are writing MP, that is market price. And here T1 is expected dividend per share at the end of the year. And this is the formula to identify the expected dividend per share. Next is NP, that is net proceeds per share, and MP is market price per share. G is here growth in dividend. So let us see an example concerned with calculation of cost of equity capital. ABC Limited plans to issue 1 lakh new equity shares of rupees 10 each at par. The flotation costs are expected to be 5% of the share price. The company pays a dividend of rupee 1 per share, and the growth rate in dividend is expected to be 5%. So all the required information is given in this example. That means here you can see number of equity shares, rate per share is given, then flotation cost, that is expenses incurred by the company or expected to incur by the company while issuing shares is given, that is 5% of the share price. Then amount of dividend is given, 1 rupees 1 per share, and very important thing required For calculating cost of equity by growth method is given, that is growth rate in dividend is 5%. So now we are required to calculate or compute the cost of new issue of shares, and next is they are also expecting to calculate or compute the cost of shares if the current market price of the share is rupees 15. That means here it is required to calculate the cost of existing equity capital also. So two calculations are involved in this example again. So let us see how to solve this type of example. First, I have written here formula for calculating cost of new equity shares and putting all the figures amount given in an example. You will get this particular solution 1 divided by into bracket 10 minus 0.50 plus 0.05. That is the growth rate given. And by solving this, we get cost of new equity shares is 15.53%. The net proceed is calculated by deducting flotation cost from the price of the share. Now next is cost of existing equity share, written formula first, and then here we are putting the figures amount given. So dividend is 1 rupee per share divided by 15. Now 15 is a market price given in second calculation, and growth rate remains same 0.05. And by solving this equation, we get the answer 11.67%. So this is the cost of existing equity shares if the company is expecting growth in dividend of equity share. Now the next method is earning yield method. So according to this approach, the cost of equity is the discount rate that capitalizes a stream of future earnings to evaluate the shareholding. It is calculated by taking earnings per share, that is EPS, into consideration. So, formula used for calculating cost of equity by using earnings yield method is K is equal to earnings per share, that is EPS, divided by NP, that is net proceed. And this formula is for calculating cost of new equity shares. And for existing equity share, formula is again remains same. Only the change is instead of net proceed, we write MP, that is market price. So EPS divided by MP. So let us see an example concerned with this method. So XYZ Limited is planning for an expenditure of rupees 120 lakh for its expansion program. Number of existing equity shares are 20 lakh and the market value of equity share is rupees 60. It has net earnings of rupees 180 lakh. Now you are required to compute the cost of existing equity share capital and the cost of new equity capital, assuming that the new shares will be issued at a price of rupees 52 per share and the cost of new issue will be rupees 2 per share. So again here you can see the information given which will help us to solve the example. First, information is given concerned with an expenditure that is 120 lakhs they are planning to spend on expansion. So for that purpose, they are issuing 20 lakhs equity shares and the market value of equity share is rupees 60 and earning they are expecting or earning is rupees 180 lakhs. Okay. So on this basis now we will apply the formula and see how much cost of existing share capital is coming. So let us solve this. So cost of existing equity shares, this K is equal to EPS divided by MP. That is market price is already given to us. So first we have to calculate EPS. They have not given directly earning per share figure to us. So we are here first calculating EPS. So 180 lakhs divided by 20 lakhs is equal to rupees 9 per share. That is earning per share is rupees 9. Now what is this 180 lakh? This is earning of the firm 180 lakh and 20 lakh is the number of shares the company is issuing, and by applying this formula, that is income divided by number of shares, will give you the earning per share, that is rupees 9 per share. Now apply the formula 9 upon 60. 60 is a market price given in an example. Thus, the cost of existing equity shares is 15%. Now, let us see the cost of new equity shares. The formula is EPS upon NP. EPS is already we have calculated, so the same figure we will continue here. 9. NP is net proceed. So now it is given that 52 rupees is the price of the share and 2 is a expenses rotation, and then by this way cost of equity is 18%. So this is the way we can calculate the cost of equity shares by applying various methods. Various approaches are there depending upon the information with us, depending upon the interest of the company. We can decide the cost of equity capital. It is already have an argument that there is no cost of capital. Actually there is no legal binding on payment of the dividend to equity shareholders, so it does not involve any cost and all. So for knowing the interest of the people, what they are expecting from us, if they are investing money in our business, definitely they expect something in return of that investment, and for that purpose, for understanding their expectation, normally firm apply any of these method for calculating cost of equity. So here I am ending my session where we have already discussed about the cost of equity and different approaches for calculating the cost of equity capital, which is a very important source of finance for the multinational organization or joint stock company. And in next lecture, we will discuss about the cost of retained earnings and we'll see the weighted average cost of capital. Thank you.